Did you know that if you're not investing, you're actually losing money every single year? Sounds a bit dramatic, right? But it's true. And it's all thanks to a sneaky little thing called inflation. Imagine you stash $1,000 in a jar and leave it there for 10 years. Because of inflation, when you pull it out, that same $1,000 might only have the buying power of what $800 buys today. Essentially, your money gets weaker over time if it's just sitting there doing nothing. Now, inflation rates aren't the same everywhere. They vary from country to country depending on their economy and policies. But since many of you are watching from the US, let's get real for a second. Over the last few decades, the average annual inflation rate here has hovered around 2 to 3%. That might not seem like a lot, but trust me, it really adds up over time. But hey, congratulations! Just by clicking on this video, you're already ahead of the curve. Think of it this way. If you spend more than you earn, you go into debt. If you just save money in the bank, you're slowly losing to inflation. But if you invest, your money has the potential to grow faster than inflation, and that's the real key to building wealth. Welcome to the Investor's Brief, where we make investing concepts simple and easy to understand. Just a quick heads up, this video is for educational purposes and isn't financial advice. Now, before we even think about diving into how to invest, there are 4 super important things you need to take care of first. Number 1, kill high-interest debt. If you're carrying credit card debt with a 15, 20, or even higher interest rate, just pause right there. It makes 0 sense to chase a 7 to 10% return on an investment when you're losing double that every month to debt. It's like trying to fill a bucket with a giant hole in the bottom. Pay off those high-interest debts first, especially anything over 6 or 7%. This isn't just a smart financial move, it's a guaranteed return. Paying off a debt with 20% interest is like earning a 20% return, risk-free. You won't find that in the stock market. Number 2, build an emergency fund. Here's the deal. Life is unpredictable. Your car might break down, you could face a job loss, or a surprise medical bill could pop up. You absolutely do not want to be forced to sell your investments, especially at a loss, just because you suddenly need cash. That's where an emergency fund is your lifesaver. Aim to save at least 6 to 12 months' worth of living expenses in a high-yield savings account. Somewhere safe, secure, and easy to access. This way, your money isn't just sitting there losing value, it's earning a little something while being ready for you when you need it most. Ready to make your money work for you and actually beat inflation? Let's dive into it. First, you need a stable source of income. Investing isn't a get-rich-quick scheme. It's about consistent contributions over time. To do that, you need a steady paycheck, whether from a job or your own business. The golden rule? Never invest money you can't afford to lose. Next, you need to learn the basics. The great news is, you're already doing that just by watching this video. So grab some popcorn and let's get started. Before you invest a single dollar, you need to ask yourself 2 crucial questions. First, how long can I leave this money invested? Are you saving for a house in the next few years, or can you let this money grow for decades? This is your time horizon, and it's a game changer. The second question is, how much risk can I really handle? Be honest. How would you feel if the market suddenly dropped 20%? Your plan is only as good as your ability to stick with it when things get shaky. If you panic and sell at the first sign of trouble, even the best strategy will fail. All right, now that you've figured out your time horizon and risk tolerance, let's look at what you can actually invest in. We'll go from the safest options to the riskiest. Let's start with the absolute safest place for your cash, a high-yield savings account. Now, this isn't technically investing, but it's the perfect spot for your emergency fund or any money you'll need soon. Your money is safe, usually insured by the government, and you earn a decent return that helps fight inflation. Plus, it's super liquid, meaning you can get your cash anytime. With interest rates up, some online accounts are offering 4 to 5% a year. That's way better than the 0.01% you get from a traditional bank. This won't make you rich, but it provides essential safety and stability. Next up on the risk ladder are bonds. Think of buying a bond as lending your money to a government or a company. In return, they pay you regular interest and give you your original investment back at the end of a set period. For example, if you buy a 5-year bond for $1,000 at a 3% interest rate, you'll get $30 every year. After 5 years, you get your $1,000 back. Bonds are great for predictable income, and they help balance out the riskier parts of your portfolio. But there is a small risk, called credit risk, which is the chance the borrower might not be able to pay you back. We've covered the basics of building a solid foundation. In our next video, we'll get into the more exciting stuff like stocks and ETFs. Ever wondered about bonds? Think of them like a loan you give to a government or a company. In return, they promise to pay you back with interest. Every bond has a credit rating, kind of like a trust score. A higher rating means it's safer, but usually the interest you earn is a bit lower. A lower rating is riskier, but the potential reward is higher. When you buy a bond, you're usually locking your money in for a set time, say 2, 5, or even 10 years. But what if you need that money back early? You can sell your bond, but there's a catch. You might not get back what you paid for it. Imagine you bought a concert ticket for $100. Then the band adds a second show, and tickets for that are only $80. Suddenly, your $100 ticket isn't looking so hot, right? Bonds work the same way with interest rates. If rates go up after you buy your bond, new bonds will offer better returns. This makes your older, lower-rate bond less attractive, so you might have to sell it for less than you paid. But if interest rates fall, your bond becomes a star. It's paying more than the new ones, so you could sell it for a profit. It's a bit of a dance, and definitely not as simple as a savings account. Now let's talk about one of the most powerful tools for beginner investors, index funds and ETFs. Forget trying to pick the next big stock. With these, you buy a whole basket of stocks at once. For example, an S&P 500 index fund gives you a tiny piece of the 500 largest companies in the U.S. You're not just betting on one horse, you're betting on the entire race. We're talking tech giants like Apple, healthcare leaders, big banks, you name it. And it doesn't stop there. Want to focus on a specific area? There are funds for that too. The NASDAQ 100 tracks the biggest tech companies. There are funds for healthcare, energy, and almost any industry you can think of. Because these funds just follow an index automatically, they don't need expensive managers making decisions. This means the fees are incredibly low, often just a few cents for every $100 you invest. So, what's the difference between an index fund and an ETF? Think of it this way. Index funds are priced just once a day after the market closes, so any order you place during the day gets settled at that final price. ETFs, on the other hand, trade all day long, just like individual stocks. Their prices go up and down throughout the day, giving you more flexibility to buy or sell whenever you want. That's a quick look at bonds, index funds, and ETFs. Let me give you another reason to stay subscribed to this channel. So, let's dive deep into the world of investing, but we're keeping it super simple. Let's start with two of my favorite options for beginners, index funds and ETFs. Think of these like a big basket of investments. Instead of picking just one apple, you get a whole fruit basket with hundreds or even thousands of different fruits. This is called diversification, and it's your best friend for reducing risk. What's great about ETFs, or exchange-traded funds, is that you can buy and sell them throughout the trading day, just like a regular stock. This gives you tons of flexibility. The best part? They are incredibly easy to set and forget. If you believe in the long-term growth of the economy, a popular strategy is dollar-cost averaging. This just means you invest a fixed amount of money regularly, say every month, no matter what the market is doing. Some months you'll buy when prices are high, other months when they're low. But over time, this strategy helps you average out your cost and avoids making emotional decisions based on market panic or hype. So, what kind of returns are we talking about? Historically, broad market index funds like the S&P 500 have returned about 7 to 10% per year on average after inflation. Now, a quick disclaimer. Past performance never guarantees future results. But when you're investing in the 500 largest U.S. companies or a global index with thousands of companies, You're essentially betting on the long-term growth of the world economy. Now let's talk about the flashier side of investing, individual stocks. This is probably what you think of when you hear stock market, but it's also the riskiest. When you buy a stock, you're buying a tiny piece of a single company. If that company succeeds, your stock price can soar, and you might even get dividends, which are a share of the company's profits. But if the company struggles, the stock price can plummet, and you could lose a lot of your investment. So why would anyone choose individual stocks? Well, some people love the thrill of the hunt. They study companies, analyze financial reports, and try to pick the next big winner to beat the market averages. And yes, a very small number of people are successful at this. But remember, stocks are much more volatile than index funds. To be properly diversified, you'd need to research and own dozens of different stocks across various industries, which is a ton of work. And guess what? That's exactly what an index fund already does for you, automatically. So, should beginners invest in individual stocks? Honestly, it depends on your personality and risk tolerance. Most beginners are better off starting with index funds or ETFs. They're simpler, more diversified, and still offer solid growth potential. That said, some people enjoy dedicating a small part of their portfolio, maybe 5 to 10%, to individual stocks they believe in. They do it not necessarily to get rich quick, but to learn more about business and because they find it fun and they're fully prepared for the risk. And that's a wrap on our beginner's guide. If you've made it this far, seriously, give yourself a pat on the back. You're taking a huge step towards building your financial future. If you found this helpful, I'd really appreciate it if you could hit that like button and subscribe for more content just like this. Thanks so much for watching, and I'll see you in the next video. Bye.